I'm Charlotte McLeod with investingnews.com, and here today with me is Matt Piepenburg, partner at Matterhorn Asset Management. Thank you so much for
It's
being
great
here.
to be here.
Nice to see you. We're here at the Rural Symposium in Florida, and just because it's our first time talking, I wondered if you could tell me just briefly about your background in the precious metals industry and the work you do.
No, I came to precious metals from risk assets. I was a hedge fund manager during the dot-com bubble of the late 90s. Was kind of an accidental tourist in risk markets, stocks and bonds. A good friend of mine had been an investment banker, and he called me in, and before we knew it, we were hedge fund managers with, we like to say, the money of friends, family, and fools. We really weren't that sophisticated. We were lucky enough to get into what at the time was called a pre-IPO that Goldman Sachs had underwritten, and we were not that bright. They did all the due diligence. We signed the documents, and months later, we kind of hit the lottery. And that's a story that everyone loves to hate because it's obnoxious, but it is what it is. It's like the Bitcoin millionaires at the time in the late 90s. That was pretty common in that small circle, but it did force us and force me to become more professional after the fact. And we made some mistakes, but ultimately I learned about risk management and about investing kind of after I've started this fund. And after winning that lottery, and fast forward many years with a family office and a team of analysts and meeting after meeting after meeting with really smarter folks than me in hedge funds or private equity or even some VC, I got an education just through trial and error with smarter portfolio managers. And as I started looking at returns and looking at markets, which is very important, you also have to just look at what really is money, what really is wealth. And then as opposed to just thinking of how to acquire more, you get to a point where your priorities with family or with yourself is how to preserve what you have. And that's how I got into precious metals, not as a speculation asset, not as some way to, get a multiple that was off the charts. It was really, how do I preserve the purchasing power of a currency that I understood was getting weaker and weaker because it was becoming devalued in a very debt-soaked backdrop and in a monetary policy that solves a debt crisis with more debt that they pay for with printed money. So it wasn't that hard to see that no matter how you measure your wealth, whether it's in a checking account or a portfolio, that was kind of death by 1,000 cuts. It's slowly losing its purchasing power. And so gold to me was very simply a wealth preservation asset. And I looked at Matterhorn as an investor. I started speaking with its founder, Egon. It didn't take long to see that we were very much on the same page, and really just became a member of the team and later a partner. And he's been a great mentor, a great friend, great colleague. And we both have high conviction that what we're doing is good for the world, not just for our clients, but for anyone, whether they're our client or not, to understand wealth preservation principles, and precious metals is one avenue towards it. And to that extent, we service the precious metal side of that.
Okay, really good to have that background. And of course, so here you talk right now and in other interviews, etc., mentioning gold as a tool to preserve your wealth. This is going to be kind of a broad question, but let's see where it goes. So what do you think is the biggest threat right now to people's wealth?
There's so many. It's a fair question. I mean, obviously, I think there is a stovepipe thinking. I've seen this before. Kind of when you get to a certain age, you're like a veteran now. I saw the dot-com bubble. That was the lottery period of the 90s going into 2000. I saw the run-up in the subprime. I didn't time it or call it profoundly, but I saw two massive bubbles in the 2000, 2001 NASDAQ, and then the S&P and the subprime crisis, 2007, 2008. And then the everything bubble, which was really a direct correlation to monetary policy, QE1, QE2, QE3. It's very simple. When you're printing trillions of dollars, it's a liquidity tailwind for risk assets. What I see as a risk to people's wealth right now is the same thing I saw just prior to the dot-com bubble or just prior to the subprime bubble, and right now as we peak out at an everything bubble, is kind of head in the sand mentality. I see everyone learns, or you're told by your parents or your grandparents or your mentors, never buy at the top, sell at the top, buy at the bottom. But, it just never happens. There's consensus thing. What I see now as a risk is a lack of contemplation of potential risk. That doesn't mean you have to be gloom and doom. It doesn't mean you have to be a bear. I see a lot of groupthink, a lot of consensus think that the Fed has our back. There's an airbag. Bad news in the markets is good news, because if there's bad news, that means the Fed will become more dovish, eventually pivot towards more liquidity. The sense that the Fed has outlawed recessions, that we can have deficits without tears, and that no matter what, even if we have a major drop like we saw in March of 2020, even that can be saved by mouse click money at a central bank near you. And so the idea of risk and the idea of free market price discovery and the idea of even thinking risk is kind of becoming diluted, like the currency. And that can be very dangerous if you haven't experienced real drawdowns that don't V-shape. And frankly, this generation since I came in hasn't really experienced that. We certainly haven't experienced inflation. So it's a lot of out of sight, out of mind. It's a lot of, I think it's okay to be a speculator. It's okay to take risk if you know how to do that. But I think the biggest risk to wealth right now, one of the biggest, is just a lack of priority to risk thinking as opposed to just return thinking. And obviously the other major risk right now is the hidden, invisible risk of currency debasement, which isn't just inflation, which is coming down now. We can talk about that, but currency purchasing power, since we took gold off of the currency, since we took the dollar off the gold standard, again, it's kind of a repeated phrase, but it's since 1971, we've lost 98% of the inherent purchasing power of that currency and other major currencies. So there is this, again, slow death of the purchasing power. And again, people say, well, the dollar is strong. I say that's true. It's stronger than other currencies, but it's like saying you're the strongest patient in the ICU or the strongest, the cleanest shirt of your laundry. That's not just an aphorism or a phrase or a cliche. It's something to think about fundamentally.
Right. And I think that group mentality is really showing at least in the soft landing scenario that we keep hearing about. So, and that's good to bring up right now, I think, because we got the Fed meeting today, 25 basis point hike, and we have people thinking, okay, maybe they're going to pull it off. So thoughts on that?
It reminds me of, I think you're too young, and George Bush Sr. said, read my lips, no more taxes. Or George Bush Jr. said, mission accomplished on the aircraft carrier in the war in Iraq. Or when Ben Bernanke said, QE will not have consequences. Or when Janet Yellen said, we may never see another recession in our lifetimes. There's a lot of, I think, pablum right now about we're going to have a soft landing. The Fed has accomplished everything. I think it's way too soon to say that. We're only in the third inning or the third chapter of this narrative. The truth is, we have already had a hard landing in many different ways. Even prior to the rate hikes in 2019, there was cracks in the credit markets when the repo markets imploded in 2019. Then in 2020, the COVID crisis crash in March was a disaster only solved by unprecedented liquidity from the Federal Reserve, trillions and trillions and trillions of dollars in a matter of months. And then, of course, we had the gilt implosion in the UK last year, and we just had a banking crisis this year. So I wouldn't say any of those were soft. And I don't even think that's the end of the game. To declare victory now is extremely arrogant. I think, pride comes before the fall. I don't think we're even close to the end of this book yet or the end of this game. And I think it's worth noting on a technical level, the amount of U.S. Treasuries, IOUs from Uncle Sam, that are just not being purchased by foreign investors, and the spread between that and the U.S. deficit is really the same where it was in March of 2020 before the markets crashed. So there's this gap where there's not enough buyers for Uncle Sam's debt. That money has to come from somewhere, and I think it's important for investors to realize if it doesn't come from investors, if it doesn't come from the market, it will have to come from a mouse clicker. In other words, it will have to be fabricated synthetically. That's incredibly inflationary, incredibly disruptive. So our bond market is the thing. And Luke Groman said something, I think, the other day that really makes it real simple. If you start from the premise that the Fed will never allow banks to fail, the too big to fail, not the small banks, the major banks, which are effectively branch offices of the central bank. If you assume that the Fed won't allow banks to fail, the big ones, and if you assume they're not going to allow treasury auctions to fail, in other words, the bonds to default from the U.S. government, then you work backward from that premise, you're going to have to create trillions and trillions of dollars of liquidity. I believe that premise, and I work backward from that. That liquidity will be highly, highly inflationary. And again, if the markets go up on that liquidity, I say that's running uphill in roller skates, because you may be getting better returns, but the purchasing power of that return is measured in dollars that have less and less value. It's very conceptually hard to imagine when you're just seeing up and to the right returns. So those things are very much on my mind, and I don't think this is a soft landing. Just because today is sunny doesn't mean it's sunny tomorrow. That's not gloom and doom. It's pretty much basic math.
Okay, really, really good points there. And I have one more comment on Fed, because one of the themes that seems to have been emerging here is people talking about this FedNow system that's just been launched. So it seems like people are generally okay with this. It's an instant payment system. Okay, we're fine with that. Where we're less fine is if this is taking us toward a CBDC path. So any comments you would share?
Well, I think that's exactly what it is, right? It isn't a central bank digital currency where your checking account or your assets are a liability on the balance sheet of a central bank. In other words, it's not like your checking account is like a Visa account that the Federal Reserve has control over, can see what you spend and turn it on or off on a dime. That's the danger of central bank digital currency. What scares me about this is, look, if I were a master planner of this slow rollout, it's kind of like, I say you can't get half pregnant, you can't have a half war. You're either in or you're in. In other words, you're either in Vietnam or you're in a police action or you're in a war. And I don't think that the SDR or the FedNow and these things that they're creating are going to just stop there. I think it's a slow drip towards the pretext for central bank digital currency. The Bank of International Settlement already has a mandate to all the central banks that by 2025, each central bank has a CBDC. That's not that far down the road. Now, even if they're off by a couple of years, I would slow drip these type of policies now and these type of programs now so that it's an easier pill to swallow when it comes time to announce CBDC. And I think CBDC won't be announced until we've hit the iceberg and the boat is sinking and there's only a few lifeboats. And investors and citizens are afraid, and they will come out and say, this is for your own good. This is to have better rates, better safety, better control, better trade efficiency. And they'll kind of Trojan horse CBDC in a time of market crisis. So they're just kind of telegraphing and anchoring CBDC now through these programs. It's exactly what a special ops would do or an intel organization would do. They would do it slowly. They would slowly telegraph it, anchor it, and then wait for the opportunity to use it. And that's not doom and gloom or conspiracy theory. It's common sense. That's a MO. That's the practice I would use. It's the practice these banks are going to use. The IMF and the BIS have already effectively said we're going to need central bank digital currency anchored in some real asset, probably gold, which would be good for gold. But central bank digital currency is very bad for citizens. And so what do you want, your freedom or your payment efficiencies? And I think when people are broke and when there's a market crisis, they make desperate decisions and they say yes to things they wouldn't say yes to. They're kind of coerced. I think it's very dangerous. It's very clever. It's very dangerous. But this was something we talked about before we started filming. One of the things that's not so I think, quantifiable or discussed, and I've given some lectures on this in Germany, is some presentations, and this is, again, without exception. It isn't a gloom and doom. It isn't a necessarily positive thing. But if you look throughout the history of nations, and this goes back to ancient Rome, the Ming Dynasty, Latin America, and every regime change, Chairman Mao, the French Revolution in the 1790s that precursed, Napoleon, and certainly the 30s in Italy, Spain, and Germany with Weimar and Hitler, and then Mussolini and Franco. You really can, anywhere on the globe, anytime in history, once a nation or a regime or even a king is in debt up to his or her ears, the next thing always happens is there's a financial market crisis. There's always a currency crisis of some type, whether it's in, Roman coins or printed money. And that currency crisis causes inflation, which causes social unrest, fracturing of all kinds, left, right, identity politics, racial politics. It's always often economic. And from that social unrest comes increased centralized control from the extreme political left or the extreme political right. And whether you're in Canada, the US, the EU, London, certainly in Eastern Europe, the evidence of that type of centralized control, that slow drip centralized control, whether it's in media censorship, whether it's in surveillance state through Microsoft or Amazon or Google, whether that's in a centralized bank, whether that's in a centralized currency, whether that's in a centralized politicized Department of Justice. Again, you can go on, and you can stovepipe each of those things. We're seeing the slow erosion of the Bill of Rights in the U.S. and all the things I studied in law school and the first 10 amendments to the Constitution. We're seeing, John Whitehead is right, we're effectively in a martial law state with a lot of our amendments. That's not extreme, again, sensationalism. It's actually true. I was joking this morning. It's not funny, but John Whitehead was saying we have 1.6 billion hollow tip ammunition rounds in the U.S. government agencies, and that's not the CIA or the FBI. That's like the Department of Agriculture, the Department of Education, even Amtrak. So we're an armed society, an armed agency. We have a surveillance society. We have a truncation of rights, and that's not even talking about central bank digital currency. So I guess my point is, all the way back to the FedNow, these are all slow drips towards things we're already feeling. It's not always just what's on the portfolio, your balance sheet. It's what's happening to your individual rights, what's happening to your financial freedom, your political freedom, your choice, debate, etc. That to me is sad. And I think that's, the more things change, the more they stay the same. We're seeing that same cycle play out right now historically. I think that's quite interesting.
It is quite interesting, and when you explain it in that context, it becomes very easy to see how we could get to that situation. Another topic I was going to bring up that is in much discussion here is the BRICS meeting coming up next month. So we have that coming up. Maybe we hear about a new currency. Maybe it's backed by gold, commodities. Can you help us unravel what we might see there?
I mean, I could be wrong, but luckily I date stamped an article I wrote last week. I didn't see a BRICS gold-backed trade currency coming out in August of 2023. There's been a lot of hype, and I can understand that. There was a leak by a Russian embassy in Kenya, and there was an RT news report out of Russia. So people grabbed onto that and clickbaited that and made it sensational, I think, too soon. And that doesn't mean there aren't some really important things to talk about there. I think that kind of hype before we have verification is bad for the industry. I think it's bad for investors. I think we need to trust but verify before we start making conclusions. That said, there is no doubt that de-dollarization is a real thing. And that began the moment we sanctioned Russia in 2022. We've written and talked about that from the day it happened. There's no doubt that genie doesn't go back in the bottle for a number of reasons. There's also no doubt that the BRICS are going to come up. There's already 41 nations in the world in bilateral trade agreements outside the U.S. dollar. There's no doubt that the BRICS and the BRICS plus nations, which probably would include the Eurasian Economic Union, the Shanghai Cooperation Organization states, when you combine that with the existing BRICS, you're looking at 41 countries that are very tired of the U.S. dollar controlling everything. So my point is, and even China since 2008 has said we need a neutral reserve currency. They've been saying this since 2008. But what's more important is, the Russian central bank themselves said it's going to take a long time for a BRICS currency. So that's not going to happen in August of 2023. I don't think it's going to happen. And I also think that the sponsors of this BRICS convention have already said it's not going to happen. So you got to take that seriously. India has been saying it's not going to happen for a number of reasons. There's a lot of reasons why certain countries are not ready for this. There's a lot of reasons why there's questions about, is there even enough gold to really back it? I think there is. It's about 5,400 tons. Tons. That's about 350 billion U.S. equivalent against 13 trillion in total gold in the world. That'd be enough to back a BRICS currency. If they did do that, it wouldn't be a big dent or threat to the U.S. dollar yet. But far more importantly, the point is, I don't think it's going to happen yet. But I do think it can and eventually will happen. And I think the real important thing to take away from all this hype is, don't forget that the trajectory away from the dollar is real. The magnitude and speed of that has been exaggerated. I think it's important for gold bugs or gold bulls who are very tired of the dollar hegemony to slow down so that people can be sober. I'm very negative on the dollar. I'm very negative on central banks, and I'm very much sympathetic with the BRICS nations to try and find a currency outside of the U.S. dollar to the tail wagging their dog. But we've got to take a deep breath on this and be realistic. And the trend is there. The speed is not there yet. The preparation is not there yet. We're getting plenty of signs of that. But I think the very fact that we're already seeing in a post-sanction world a large chunk of the population in the BRICS plus nations, which are going to surpass the G7 in GDP, the very fact that they're already thinking about trading outside the dollar is important. I think eventually a trade currency, not a national currency, but a trade currency backed by gold will come around, because that gives them trust, not for each other, but in the currency itself, the trade currency. It's not meaning if you're a citizen of South Africa that you can redeem your currency in gold. It means if you're trading between South Africa and Brazil, you'll feel safe in that transaction because there's gold underneath it. There's other problems with that, though, in terms of, will central banks be able to redeem from other central banks? Will they hold the gold that they promise? Will there be enough gold? These things still have to be worked out and discussed, but the trend is clearly going in that direction. But as that's happening, I think the IMF has already told the world, too, that they're looking towards central bank digital currencies backed by some real asset, gold. Regardless of how or when this plays out, gold optically and substantively is taking a larger role as currencies are, again, slowly dying inch by inch, cut by cut, year by year. For any new system, whether it's a Bretton Woods 2.0, a Great Reset, or a bailout of some form, For anything to have credibility in a far more sophisticated public, it's going to have a real asset behind it. Not just with the BRICS, but even in the G7 countries, the US dollar. And nobody, myself included, knows when that's going to play out, how that's going to play out. But the direction is pretty clear.
Okay, and as we are finishing up, hopefully we can wrap this up into kind of what this means for gold, because our audience has a deep interest in gold, of course. So these are circumstances that look positive, but as you're just saying, we know the direction, maybe we don't know the when. So what do you see for coming for gold? Let's say in 2023, can go beyond if you want.
Well, it's interesting. I think of Egon, when he started Matterhorn, gold was at under $300. And since that was in 1999, 2000, gold has gone up 6 times since then. It's outperformed the S&P. And yet people still say gold's not doing enough for us. Gold's not doing enough for us because it's not at 25 or 3,000. It's boring. I can get so much more in Bitcoin, or I can get so much more in a SPAC or some immortal tech stock. And they're right. But when I look at what gold has done for Egon or for me, and I'm someone who's benefited from silly returns on an IPO that I could have never earned, and it was more money than my parents and grandparents and their parents earned in an afternoon. So yeah, that did a lot for me, but it really didn't do anything for me other than make me a lottery ticket winner. But what gold has done for me and Egon and all our clients is it's preserved the wealth that we had, whether we inherited it, earned it, or tricked into it. And so to me, that does a lot for me. And people I think if you're a speculator and you're saying, well, gold's not at 2,800 yet, it's not doing anything. Again, well, if it's preserving the wealth that you have, because that wealth that's sitting in your portfolio, it may be going up, but the purchase power matters. And for me and for our clients, we're investors. My first responsibility, gold is doing just fine. In terms of where gold is going, I don't even think its best days have come. I don't like to speculate on price because you're still measuring that in some fiat fantasy currency. So when gold is at 5,000, fine, but it's still going to be 5,000 useless dollars, more debated dollars, or kroner, or euros, or yuan. So it's a fair question, and it will get higher. It doesn't mean it goes in a straight line. But the world, not just the dollar, but the world reserve currency in particular, and the dollar, is in debt over its skis. It's inevitable. It is obvious. There is also, as I said earlier, no doubt that they're going to have to create synthetic liquidity to save the system. They will have to create more money to support the bond markets and the system itself. There's no doubt that in every market crash or every societal kind of crash where you have debt this level, the last bubble to pop is always the currency. And that, again, has happened from 1789 France to 1999 Yugoslavia to 1930s Deutschland or Germany. So gold will become an antidote to its, anti-fiat, and the dollar is king fiat. In terms of timing that, it's impossible. It's like saying, when will Germany invade Poland, or when will, it was 33, 34, 36, 38, 39. It really doesn't matter whether it was 36 or 39, as long as you were out before September of 39. And to me, we buy gold because we don't know. We just see currencies openly dying day by day. And we see a system more and more desperate day by day. And we see an IMF to the BRICS and the headlines. Wherever you go, somewhere gold is in the conversation. So that will obviously cause a repricing of gold, whether it's through the BRICS or whether it's through, the IMF. Gold will reprice. And those who bought it at 2,000 or 300 or 1,800 will not be asking whether they overpaid at that point, in my opinion. But more importantly, they'll know that it still has its value. And I'll say really quick, I know I'm talking. There was a story that came out in the headlines in the U.S. a few weeks ago about in Kentucky, a guy with a metal detector found a bunch of Confederate coins from the U.S. Civil War, a bunch of old coins from the 1860s, because the Confederate Army was running from the Union Army and they had to bury their state capital as fast as they could. And apparently that cavalry must have gotten shot and they couldn't find, they never went. So somebody 160 years later found that gold. And that gold is now worth tens of millions of dollars. If they had found stacks of Confederate dollar bills, that would be basically worthless. I think 160 years from now, a stack of U.S. dollar bills will be effectively worthless. And I think the point is that's generational wealth. The fact that those coins sitting in the ground are much more valuable than the paper wealth, and even much more valuable than they were in the 1860s. People don't need to wait 160 years for their gold to be valuable. What I'm saying is that's just kind of a metaphor of generational wealth preservation, because those rusty old gold coins that you can shine up real quickly in the dirt are so constant. They hold their value. Fiat currencies always revert to their mean, which is zero. And I think that's just something to think about, that little story. you don't have to wait 160 years for gold to work for you. It's working for you every day, regardless of the price in the COMEX or the futures market. And that's how we look at it. It's a wealth preservation asset. It's not sexy. It's not as sexy as Bitcoin or certain cryptos or certain tech stocks. It's also not as volatile and embarrassing when things go wrong. So if you can't time a top and a bottom and you're trying to preserve wealth, I think our asset is the right one. If you're looking to get rich quick or to really get a leverage or a multiple, there are other things you could look at, not probably gold. But I still think in terms of even price movement, gold's going to do fine in the next 15 years, the next 15 months.
Oh, hey, I think those are really good reminders for investors and a very illustrative story that I think proves your point quite well. So a good place to wrap up.
Yep.
But thank you so much for coming to talk.
Yeah, my pleasure.
Really nice to have you. And once again, I'm Charlotte McLeod with investingnews.com, and this is Matt Piepenburg with Matterhorn Asset Management. Thank you for watching. If you like this video, make sure you subscribe to our channel. We'd also love to hear your thoughts, so leave us a comment below. We'll see you next time.